Very good evening, viewers, and thanks so much for tuning in to the Business Today show. I'm Chaiti Narula, and let's kickstart this show with the top news that we have for you this evening. Christmas cheer clearly missing on Dalal Street. Sensex falls 635 points down more than 1,600 points in a week. Broad-based selling across nearly all sectors over concerns of COVID cases rising globally. The government goes on an offensive against resurgent COVID, announces random sampling of all those arriving from overseas, says there are currently 10 different variants of the virus in the country. Tata Group heads for IPO street again. Online grocer Big Basket expected to list its shares in the next 24 to 36 months. Company is valued at over $3 billion. And the RBI governor's big warning, the next financial crisis will occur due to private cryptocurrencies. Shaktikanta Das reiterates that cryptocurrencies should be prohibited. The statement comes even as the central bank tests its own digital currency. Great news coming in for banking stocks. The finance minister says non-performing assets are at a 6-year low. Tells the parliament that NPAs of both the public and private sector banks hit a low of 5.9% in March this year. Beginning our coverage with all the market action now. Wednesday washout on the Dalal Street was witnessed. Sensex and Nifty gave up early gains following the weak global cues. Sensex tumbling over 600 points to settle below the 61,000 marker, as reflecting on your screens right there, down 1.03% in today's intraday trading session. And let's see how the Nifty fared today as well, witnessing a decline of over 180 points to end below 18,200. From the Nifty pack, let's see who the top Nifty losers were. There you go. Adani Enterprises, Adani Ports, Ultratech, Indus Bank, Bajaj Finance. All these were the major laggards in today's trading session. On the other hand, you had pharma stocks that were bucking the trend. Divi's, Cipla, Polo Hospital, Sun Pharma, Dr. Reddy's. They were all the top gainers, as you can see on your screens, with Divi's topping the chart, 4.88% up in today's trading session. The SEBI is all set to tighten the noose and deepen security of the largest broking firms in the country. About 15 to 16 of the largest broking firms, including Zerodha, Grow, ICICI Securities, Pi Pesa and Motilal Oswal Financial Services will be designated as qualified stockbrokers and will be subject to higher compliance requirements. Now, this is a part of the attempt made by SEBI to prevent concentration of broking power with too few companies.
In order to address the concentration risk which exists in our market today, there are as you know, for instance, the top 10 or top 12 brokers will account for very, very large percentage of the market volumes. So in order to mitigate the concentration risk, what is proposed is that on the basis of some very transparent criteria, first of all, certain brokers will be identified or designated as qualified stockbrokers. And there will be an enhanced requirement on them in terms of risk management, of course, all types of risk, market risk, IT risk, cyber risk, etc. Much higher standards will be expected of them. And there will be a higher obligation on the MIIs and on SEBI in terms of monitoring them as well. So, for instance, in terms of our inspections, etc., frequency of inspection, regularity of review, etc., all of that, there will be a greater responsibility on the MIIs and on SEBI as well.
We're now being joined by Ashish Rukhyar from Mumbai. He's our senior associate editor. Ashish, is this likely to have any kind of an impact on the investors who are dealing with the designated QSBs?
So at an investment or an investor level, there is not going to be much of a change. But first, let's quickly understand what this whole concept of qualified stockbroker is. So SEBI has said that certain stockbrokers in the market, they handle a very large number of clients, very large amount of client funds and also large trading funds. And any possible disruption in the services of such brokerages or broking firms or any disruption or failure could lead to a wide impact on the market and the investor community at large. So that's the reason SEBI has said that to mitigate this concentration risk, they have come out with this new category of stockbrokers called qualified stockbrokers. This is basically it's part of SEBI's larger attempts to address the concentration risk on account of the market share of some of the largest broking firms. Now, SEBI has said that there will be enhanced risk management requirement on in terms of say market risk, IT risk, cyber risk. So obviously, this whole enhanced obligation is part of SEBI's attempts to ensure that there's no kind of disruption or failure in terms of services of these broking houses. Now, if you see the last couple of years, I've seen an influx of a large number of retail investors, and many of the broking firms that now account for some of the largest number of clients, whether it is Zerodha, Grow, Upstock, ISEC, Motilal Oswal, Financial Services, 5paisa, IFL. I mean, these are some of the biggest broking firms, and they deal with a large number of clients. Just to put things in context, if you go by SEBI data itself, there are more than 1,300 registered stockbrokers in the country. But if you see, the bulk of the trading turnover is accounted by just top 10, 20, or maybe at max 50 stockbroking firms. SEBI data itself shows that more than 80% of the trading turnover on BSE in the month of November was from the top 25 brokerages. Now, if you look at the same data for NSE, which is the largest stock exchange, the share of the top 25 brokerages was pegged at a little over 72%. So obviously, this whole issue of concentration risk is actually a big risk, and SEBI has taken its first step towards ensuring or mitigating any kind of concentration risk that could in future emanate from the concentration or the large number of clients of these broking firms. And this is not the first time that SEBI has introduced this concept. Right. We already have this concept for RTA, that's the registrar and transfer agents. We have a certain category of qualified RTAs, wherein if you have number of folios, if your number of folios that you manage.
So we'll wait and watch to see if the broking firms have taken the news well or not, and whether they are okay with the enhanced compliances. For now, it's a wait and watch. Thanks much. Appreciate you joining us on this particular broadcast. Now, with the SEBI tweaking the present share buyback norms for listed companies and tightening the disclosure rules, what is going to be the impact of these on the companies and to the brokers? To understand this better, we spoke to Sunil Damania of Markets Mojo and Kranti Bathini of Wealth Mill Security. Here is an excerpt from that conversation.
Well, you know, there's some bigger decisions being taken by the capital markets regulator as well. So I'll take your viewpoint over there. We'd heard yesterday that SEBI has decided to phase out the mechanism of buying back of shares by companies through the open market route in a gradual fashion. Now, many believe this is following the recommendations made by the KK Mystery report, which suggested that open market share buybacks are actually prone to be misused and should therefore be phased out. And the decision was a part of the several major decisions that were otherwise also taken by SEBI too. So first of all, your thoughts on this entire news, and you know, how will it really benefit the small retail investors going forward?
So Sakshi, if you look at this mechanism of buying back through the open market, was definitely not beneficial to the small investors. Why? Because first thing, you don't know when company is going to buy back, because it says a long window is available and which date, and again they would give the maximum price, but that maximum price is always much higher than the current market price, and we don't know you know, how much quantity the bank company is going to buy on a daily basis. In the tender offer, against tender offer, you have very clear source or that company is going to buy back that much quantity of shares and the price, and that improves your chances of making money on that. So if you look at the data which is available, Sakshi, on the complete buyback which is done through the open market mechanism, they hardly move the needle for the sale prices. But when it comes to the tender offer, it did benefit small investors very. So I think it's a step in the right direction. It was need of an hour. I'm a little surprised why SEBI did it now. They should have done it 6 months back or maybe 9 months back. This kind of exercise was not making any sense from the shareholders' point of view, and it was anyway not helping to improve the sentiment on the sale price also. So I think it's a move in the right direction.
How will this news really impact the brokerage houses and the broking community and the investors going forward too?
So I think it's a move, and I'm not very sure how much is going to take away the market share from some of these leading brokers, whether it's Zerodha or Upstocks or other people. I think, yes, as a SEBI's duty to ensure that you know, there is no concentration of with a few brokers. But eventually we have seen that's happening with the mutual fund industry, where few AMCs commands a much larger market size compared to what they were commanding even 10 years back, kind of stuff. And something similar happened with the discount brokerage happening. So yes, to have a check and balance in terms of IT, in terms of cyber risk, in terms of processes are being followed, that's a welcome step. But is it going to help in terms of reducing the concentration from this broker? My answer seems to be no. In fact, some of the smaller brokers are anyway giving away that space to the larger brokers. So my sense is that it's going to remain the same. It's going to remain. But this kind of an oversight is a welcome move. That will definitely help to improve any kind of an unwanted mishap that could have happened because of cyber or because of IT software is related issue. But it's not going to reduce the concentration risk.
Let's look at some of the news developments that we saw, yesterday overnight, and that are important for the investors to track as well. There's news from the capital regulator of the stock market, SEBI, Securities Exchange Board of India, which has now decided to phase out the mechanism of buying back of shares by companies through the open market route in a gradual manner. Now, this is following the recommendations that were made by the KK Mystery report, which suggested that the open market share buybacks are actually prone to misuse and should therefore be phased out. This decision was part of the several major measures that were taken by the capital regulator at the board meet as well yesterday. Mr. Pateni, your thoughts on the move and how should investors really view this? What does it really do? Is it a favorable measure for the investors? How do they stand to benefit? Could you give us all those clarity?
Sakshi, with respect to the measures taken by the capital market regulator SEBI with respect to buyback through stock market route is concerned, okay, so there are some operational challenges initially for the investors to tender these shares through the in the buyback offers through exchange mechanism is concerned, and the money is to directly credited into the investor's account. So there is a kind of initial operational problems with respect to the investors are concerned tendering the shares through the stock exchange route. So SEBI has come up with an advisory which is going to benefit the investors over a period of time. Slowly they are going to phase out the buyback route from the stock exchanges. So it will they are going to come up with the new measures which are going to benefit the investors over a period of time. So it is just a commentary. We need to see how the operational guidelines that are going to come over a period of time.
It is one of the biggest stories of the day. You may soon be able to waft through the airport security checks without the laptops and mobile phones and the chargers. Through the security check, you have to keep removing them from your bag and putting them in trays and just going through the security. And it takes just way too much time. In a big move to check congestion at the airports, authorities are installing modern equipment to screen bags without removing electronic devices. Finally, Business Today TV special correspondent Karishma Sudani has more on this. Take a look.
Well, right, the Bureau of Civil Aviation Security is already working on this concept. Now, this is not something new because the government has been trying to make this possible for a really long time. But the recent incident of New Delhi's Terminal 3, where there was a major congestion when it comes to the passenger traffic being crowded across the security and immigration, is where the government decided that they have to start making processes easier. Sources are telling us that government has started to do meetings on trying and using high-level technology and innovative machines in order to cut down the process that it takes for one to check in and to move ahead with the security checks. In fact, if you see many airports across the United States of America, Europe, and in fact, one of the most busiest again, Dubai, also has a similar security checkpoint where you don't have to remove your electronics or jackets or shoes to be scanned through, but it is the high 3D technology security system that is implied, which cuts down all these time-taking hassles. It is likely that government may start this process as soon as next year once they have technology in place. They want to start it with domestic routes, and then of course they want to extend it towards the most busiest international airports in the country.
The first batch of supplementary demands for grants has been authorized by the Parliament. The approval allows the central government to spend an additional 3.25 lakh crore rupees in the current fiscal. This additional spending is over and above the proposed expenditure in this year's budget. Here's an excerpt from Finance Minister Nirmala Sitharaman's reply to the debate on supplementary demands.
Multiple times both the IMF and the World Bank have said in several occasions, India is the brightest spot in the global economy and is an island of hope for global growth. So I just want to highlight the fact that real GDP growth and doubling of it is certainly a good indicator for which any government should work. But the way in which we have handled during COVID has kept us away from recession, whereas those who followed certain common principles, which was heard as advice given here also, have gone into recession.
After 2 whole years of intense turbulence, the aviation sector is hoping for some calm sailing in the year to come. However, with the financial situation of the airlines in the country far from comfortable at the moment, the industry is hoping for some relief coming in from the government. My colleague Karishma Asadani spoke to Lenish Patel of CAPA India about the aviation sector's wish list from the upcoming budget 2023.
What does the industry want from union budget? Isn't, I think, already a lot of cushion provided to them in last 1 year?
So aviation industry has always been expecting rationalization of direct and indirect taxes, especially in terms of inclusion of the ATF in GST and with full input credit taxes. The other things that it would like is there are other duties on airlines for provisions of spares during maintenance events for Indian MROs. Although there hasn't been a direct stimulus or a package that is given to the aviation industry in the past year or so during COVID, however, anything that helps the industry is always welcome.
The industry, like you also said, of course, is facing these losses, and it faces an issue of liquidity when it comes also on low finances. What do you think can be the way out of this?
So undercapitalization has always been a persistent weakness for most of the Indian carriers. This is even before COVID, and during COVID, it had a devastating impact on their financials. The only way out will be a strong recapitalization for the sustained operations of the airlines.
We're looking for a challenging, price war in the air in the coming year, because we have Air India, we have Tata, we have a new airline, Akasa, Indigo, of course, has been there, SpiceJet has been there, and there could be revival of Jet Airways. How do you see this competition panning out for the whole domestic Indian aviation sector?
So if I talk about the next coming year, so let's say FY 2024, it's possible that in many ways it is challenging, we see, especially with strong headwinds from high inflation, high interest rates. You have currency depreciation, supply chain issues, and there is, of course, the threat of COVID that is still there. And we can't forget the significant geopolitical challenges that are already there. Though, again, given these headwinds, we do expect the sector to grow in the coming year, but it's largely dependent on these external factors. Air India, which is under the Tatas now, will continue to focus on their growth and customer service, and we will see progress quarter after quarter. Akasa Air, which will be almost 30 aircraft fleet by the end of FY 24, and hence we will see quite competition from them as well in the industry. While regarding Jet Airways, resumption will depend on the clearance from NCLT and the availability of significant funding that they can gather.
Is Elon Musk's romance with Twitter leaving him poorer? That's the question everyone's been asking after the billionaire's net worth slipped to a 2-year low this morning. According to Bloomberg, Musk clocked in $148 billion, down 45% this year. Here's a look.
Elon Musk may not be as enthusiastic today. He no longer holds the crown of the world's richest man. His wealth having been eroded by more than half from the $300+ billion it touched last year. Shareholders of Tesla have clearly given him a thumbs down for his dalliances with Twitter. Musk's net worth was further eroded on Tuesday, with Tesla shares falling nearly 6%. This drop in Tesla's shares is reportedly due to the risk posed by Musk's recent acquisition of Twitter and his tendency to use the platform to share distractions and potentially controversial content. As a result, Musk's fortune is now at its lowest point in over 2 years. And with his wealth being primarily made up of shares, pose a significant risk for the 51-year-old entrepreneur. Tesla touched a lifetime high of $407 on 5th of November last year. This year it opened at $352 and closed on Tuesday at $138, down 66% from its high. Musk's fortunes have tracked this curve. His net worth touched a high of $338 billion before slipping to $271 billion at the start of this year. The Tesla erosion discharged his wealth to just $138 billion on Tuesday. Tesla shareholders are clearly tracking Elon Musk's announcements closely. The stock rose marginally on Monday when Twitter users voted for Musk's departure as CEO of the social media platform. He followed up with another tweet that he will quit as the CEO of Twitter when he finds someone foolish enough to take up the job, but will stay on to run the software and server teams. This about turn did not go down too well with Tesla investors, leading to the stock crash. Many are speculating about the future of Musk's financial empire and whether or not he will be able to bounce back from this major blow. Tesla will be releasing its quarterly deliveries report in early January, and the forecast shows a weakening demand in China, which could further impact the stock price. Bureau Report, Business Today Television.
The waiting period for MG Motors cars has been a pain point for consumers as they've had to wait for 3 to 6 months for their deliveries depending on the model and the location. Business Today's Akanksha Chaturvedi caught up with MG Motors CEO Rajiv Chhabra to figure out whether conditions would improve next year or not. Listen in to a slice of that conversation.
What's new? What are there waiting lines for vehicles? What are we gearing up for the new year? What are some new plans? Could you tell us like a sneak peek into that?
So we can't supply cars this year the way people wanted. Unfortunately, we didn't do as well as some competitors do in terms of getting the chips. But now our supplies are getting improved. So, so hopefully next year should be a great year for us. We're looking forward to crossing 100,000 vehicle sales. And we are launching another EV in April, so that's interesting.
Okay, sir. So good luck with your game and good luck for the next year for MG Motors. Thank you so much for taking out the time, sir. Thank you, sir.
South Korean carmaker Hyundai unveiled its flagship EV, Loniq 5, in Mumbai last evening. 3 cars were positioned in the front of the gateway of India, their batteries powering a light show on the monument. Bookings for the cars started today for a token amount of 1 lakh rupees. Deliveries are expected to begin only after the Auto Expo next month. The car will be assembled in India and is expected to cost less than its cousin, the Kia EV6, which retails at 60 lakh rupees ex-showroom price. No major specifications have been released as yet, but the car is expected to be powered by a 217 bhp engine with a range of 631 kilometers in a single charge. Business Today TV's Rachna Dhanrajani was at this particular event. Here's a look.
I'm standing in front of the great and mighty gateway of India. But what's interesting behind me are those 3 Hyundai Ioniq 5s. These are the first time Ioniq 5s are seen in India, and this is their way of making way to India through the gateway. What we just saw was a spectacular light show powered purely by these 3 cars. The Hyundai's first fully developed EGMP model, which is Electric Global Modular Platform. This Hyundai Ioniq 5, one of the 3 that you can see in India right now. They're only in Bombay at this point. They'll soon be coming to Delhi at the Auto Expo, which is also where the company reveals the price and India specifications for it. Right now, what we can see so far and what we know so far is that this car brags of something called ultra fast charging, which means it can go from 10% to 80% of battery in just 18 minutes of charging. And the booking price for this right now is 1 lakh rupees.
Well, that's all from me, Shetty Narula, on this edition of Business Today. Keep watching India Today, and for the latest news and updates, don't forget to log on to indiatoday.in or go ahead and download our India Today app. Thanks so much for tuning in. Thanks for your time, and a very good night.